This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. We're going to look at question 2 of the December 2009 paper F9 exam. So make sure you've got the question in front of you. And one thing you should have noticed during the 15 minutes reading time is if you go straight to the requirements and always look at them first. Part A, calculation, cost of debt, 3 marks. Part B, discuss reasons why different bonds of the same company might have different costs of debt, 6 marks. Part C, calculate the following values: cost of equity, ex-dividend share price, capital gearing, market value, weighted average cost of capital. They're 2, 3, 2, 2 marks. And Part D, discuss whether a change in dividend policy will affect the share price, 7 marks. And what you should have noticed is A and C are purely arithmetic, and since there are very few marks for each bit, it's unlikely to be terribly difficult. But B and D are purely discussion, and in total is 13 marks. So when you're deciding what order to do the questions in, bear in mind you've got to be able to do a reasonable discussion to be certain of passing. B and D, we'll deal with them when we come to them, but they're both fairly standard textbook written parts. There shouldn't be too much of a problem. Anyway, let's get straight into it. Part A, calculate the cost of debt for bond A. And so don't at this stage waste time reading the whole of the body of the question. You can see at a glance that we've got the capital structure of the company, so there's an extract there from the balance sheet. And underneath bond A, it'll be redeemed at par in 10 years' time. It pays annual interest 9%. The current ex-interest market price is 95.08. Well, it's only bond A we're looking at, so the rest of it for the moment is irrelevant. And since it's redeemable debt, very, very standard, if we base it on a nominal value of 100, set up the repayment schedule and the internal rate of return. So the market value as of now is 95.08. There's then interest each year for how many years is it? It's redeemed in 10 years. So with interest each year, it's 9% on nominal, so $9. Is the tax? No, the very, very last sentence of the question, ignore tax. It's so unusual. Normally there is tax, obviously. But the interest here, 9% of nominal, $9 per annum. In 10 years' time, there's the redemption. And they're redeemed at par, so 100. So 2 guesses approximate. And be sensible. It's $9 a year on a market value of 95, so I think my first guess is going to be 10%. But remember, any 2 sensible guesses will do. And so the discount factors, the interest, the annuity, 10 years at 10%, 6.145. The ordinary factor for the redemption, 10 years at 10%, 0.386. And so, sorry, let me get my calculator sorted. The interest, 9 times 6.145, 55.31, 38.6. And so the net present value, at 1.17 negative. And so the internal rate of return is less than 10%. I think not much less. I'll make a second guess at 8%. But I've already said any 2 guesses would have done. Make your second guess at 5% if you want. But at 8%, the annuity factor for 10 years, 6.710. The ordinary discount factor for 10 years, 0.463. 60.39. The net present value, £11.61. And so the cost of debt is the internal rate of return. We know it's more than 8%, assuming it's linear, 11.61 over 11.61 plus 1.17 times the difference between the two of 2%, which gives me an internal rate of return of 9.82%. So 3 marks. So there's a bit of time pressure there, but that should be something that really by the time of the exam should be automatic. It's so likely somewhere in the exam you'll need to do that. Let's go on to part B. Discuss the reasons why different bonds of the same company might have different costs of debt. It's a general one, so it doesn't really matter whether you got the answer to part A right or wrong. But here, bond A, we have worked out, is 9.82%, whereas bond B, it actually tells you the cost of debt of this bond is 7.82%. Now again, you don't need to refer specifically to these, but it would make sense. He's given you the clue. In that these are bonds in the same company, so presumably they've got the same risk. And so that shouldn't make any difference. But what does make a difference is that bond A is redeemed in 10 years, whereas bond B is going to be redeemed in 4 years. So that's what's making the difference. The difference is due to the time to maturity. And although it's not a rule, it's not surprising. Usually, the longer there is to maturity, as with bond A, the higher the required return. And the reasons for this, well, this is really the textbook bit. You don't really need to use the words I'm going to, but certainly be able to explain them. One reason why the longer there is to maturity, the higher the return, is what we call liquidity preference theory. But more importantly, what this means is the longer money is tied up, the higher return lenders are likely to require. A second reason that can account for it is the expectations theory. And all this is saying is if people expect interest rates are going to rise in the future, then the more they expect they'll rise, the more return they'll want. If interest rates expected to rise, in the future, then again, the higher the required return. The third thing that goes with this is the market segmentation theory. And here, different types of investors choose different times to maturity. What I mean there is some investors, they're only prepared to invest short term. They might prefer bond B. Other investors want to invest long term. Perhaps they prefer bond A. And these different investors, they have different required returns. Now, the examiner, have a read of his answer, learn from it. He's written it perhaps rather more nicer than I have. But in the time available, there's certainly enough there for the 6 marks. It's primarily the time to maturity. But he would expect a bit more than that, obviously. Again, 3 standard theories that go with it. Part C is back to the arithmetic. And again, very few marks each, so they can't be hard. If you have a problem with any of these, it's not worth wasting time. Jump over it, come back later if you've more time. Sorry about that. Number 1. The cost of equity using capital asset pricing model. Well, that's very easy. As soon as you see capital asset pricing model, you're looking for a beta. And the last paragraph, the question. DD has an equity beta of 1.2. It's the equity beta determines the return shareholders require. And so, the cost of equity, it'll be equal to the investor's required return. I always write the formula down because however easy it might be here, could have grabbed the wrong figures, but it's always the risk-free plus beta times the market return as against risk-free, straight from the formula sheet. So the risk-free rate 4%, the beta 1.2. The market is giving 11, risk-free 4. So the market premium is 7, 8.4, 12.4%. Part 2. The ex-dividend share price using the dividend growth model. Well, from the formula sheet, P0 is D0 times 1 plus G over RE minus G, where P0 is the market value. So the market value per share what's the dividend? First line. DD has a dividend payout ratio of 40%. They've maintained it for several years. The current dividend per share is 50 cents. So D0, the dividend per share, 50 cents. Times 1 plus the growth rate. How can we get the growth rate? It says the dividend per share is 50 cents. We expect the next dividend per share to be 52 cents. And so G, the dividend growth rate, we expect it to go up by 2 cents on 50, which is what? 4%. So back to the formula, 1 plus G, 1.04 over required return. Well, we've just done that, 12.4%, minus G, 4%.04. And incidentally, there's another reason for writing the formula down. If you got part 1 wrong, then of course you'll get part 2 wrong, but you'll still get full marks for part 2. As long as it's clear what you're doing, you don't lose marks twice. So 50 times 1.04 divided by 0.084, 619 cents or $6.19. Sorry, just let me check that 1 minute. My calculator gives different answers each time. 1 second. Yes, 619. Part 3, the capital gearing. Now you should remember gearing can be measured in more than one way, but he's defined it here, debt divided by debt plus equity, using market values. So what are the market values? First of all, debt. We have two types of debt. Bond A. On the balance sheet there's 20 million, but that's nominal value. And the market value of Bond A, 95.08 for $100 nominal. So the total market value, $19.016 million. The other debt is B, from the balance sheet, again 10 million nominal. The market price 102.01 for 100 nominal. So the total market value is what? 10.201. So the total market value of the debt, 29.217. The market value of equity. On the balance sheet there's 25 million. They're $1 per share, so there's 25 million shares. We've just worked out the market value in part 2, $6.19. And so total market value, 154.75 million. And so finally the gearing. Again, he's defined it, so debt 29.217 over debt plus equity is what? 29.217 divided by 183.967, which comes to 0.158 or 0.159, 15.9%. It doesn't matter, either I leave it as a percent, as I've done, or 0.159. Finally, for part C, 4, the weighted average cost of capital. Well, we've done most of the work here. Because remember, for the weighted average, we weight the individual costs by the total market values. So, equity, the total market value is 154.75. Debt A, 19.016. Debt B, 10.201. So the total market value of the company, $183.967. The costs individually. Equity we did earlier and got 12.4. Debt A, well, we did that in part A of the question, and what was it? 9.82. And debt B, we were given, were we not? Yes, debt B from the question, the cost of debt is 7.82. And so the weighted average, weight by market values, you better check my arithmetic here, but let's see if I can get it right. 12.4 times 154.75 divided by 183.967 comes to 10.43. 9.82 times 19.016 divided by 183.967. 0.02, and finally 0.43, giving a total, a weighted average cost of capital of 11.88%. And can I repeat what I said before? Clearly, one mistake in an earlier bit, if part A was wrong or if part C 1 or 2 was wrong, you'll get the wrong weighted average. But you don't lose marks twice, so for heaven's sake, set it out nicely, make sure it's clear what you're trying to do. And even if one of these figures was wrong, you'll still get full marks for showing you can do it the right way. Finally, D. Discuss whether a change in dividend policy will affect the share price of DD. Well, again, this is very standard textbook work. And what the things you'll expect are as follows. Firstly, in theory, it makes no difference. In theory, and this in fact is Modigliani and Miller who said this, dividend policy is irrelevant. The reason being, it's two things that go together. Lower dividend, well, now, if a company pays a low dividend, if they're retaining more, they'll grow more. So it means more growth in the future. And because of that growth, Modigliani and Miller say, if shareholders need the cash now, well, if they're getting a lower dividend, how can they get the cash? They can sell some shares. So that's what Modigliani and Miller say. However, in practice, dividend policy does matter. And several things you could mention. One is what we call the signalling effect. Again, you don't need to use the words, but it's nice if you do, but it's no good just writing the words. You must explain basically what we're getting at. The signalling effect is that if the dividend is lower than expected, then there's a risk or a danger that shareholders worry that the company is doing badly or the company has problems. It may not be the case, obviously. Low dividend, retain, growth in the future, but the immediate reaction to a low dividend is there must be problems. A second thing to mention is the clientele effect. In that people choose which company to invest in because of the dividend policy. Investors choose company because of dividend policy. Some prefer high dividends, in which case there'll be low growth. If the company's not retaining, it can't grow much. Others prefer low dividends. And because low dividends, if they're retaining a lot, it means there's going to be higher capital growth. And so changing the policy will affect the shareholders. So that's it. Again, the examiner's written it perhaps rather more nicely, but he had more time. I'm confident that that certainly would have got 6, if not 7, of the available marks. So, a little bit of a rush. You've got to be obviously confident of Part A, working out the internal rate of return. There isn't much time to think here, but provided you've learnt the rules and you're fast on your calculator, it's not too bad.